Welcome to part second of the video titled Block Trading, the Most Fraudulent Practice. History is witness that accounting and investment banking, I repeat, accounting and investment banking are most fraudulent in nature. The more you entered into accounting and investment banking, the sequence of frauds would unearth. And you will feel like, what the hell the regulator is doing? Remember, regulator is always an unknowledgeable person compared to others. But we will discuss this in detail later. So, guys, I will give you a simplistic example about the block trading. Block trading, so let's make a hypothetical example. There is a private equity firm called PEX. I repeat, PEX, who holds 30% stake in a hospital. I repeat, there is a private equity firm called PEX who hold 30% stake in a hospital. Now, this hospital is built up and it is in profit. They invested at a valuation of 100 billion. Today, the valuation is 2 billion. And they wanted to quit. Now, if that private equity because private equity are the people who believe in profits. They hardly bother about the company. They believe that their job is done. They invested at 100 million valuation and now it is 2 billion valuation, which means their job is done. Now, they need to sell their whole 30% stake in that hospital to the investor. But the biggest question that came, who would be arranging that investor or investors? That's a bloody point. And that job goes to investment bankers. Like top investment bankers include Goldman Sachs, JP Morgan Chase, your Morgan Stanley, and all. They are the one who get this job. But that's not easy because private equity firm will have an objective. We assume the name PEX. PEX will tell to Goldman, JP, and Morgan Stanley, I want a share price of $35. Now, Goldman need to see how he would be selling this. Now, there are two forms of deal Goldman can do. Number one shot. They will get an investor and sell the whole 30% in one shot and get $35 in their books, which they will pay to private equity, PEX, and get their fees or whatever bonus. But this looks very, very easy. But this isn't easy. Because finding an investor who can invest the whole 30% at basically in one shot is very, very tough job. So what Goldman will do, Goldman left with two options. Either they break this to 6% each and let's do 6% after every quarter. Now that private equity firm don't have the time. They will say, I don't have the time because you are proposing rather selling 6% in per quarter, which means to complete 30%, I need 5 quarters, which means more than 1 year, which is 15 months. I can't wait for 15 months because 15 months you can have another corona, you can have another geopolitical issue like Russia, Ukraine. You have you can have anything. So I can't wait for 15 months. I wanted to offload my 30% stake now. Now Goldman is in trouble. Goldman will say, okay, I have two options. I cannot let the client go. And that's the beauty of investment banking. You need to make sure that client would always be in your pocket. But sometimes you need to break the barrier. One MDV scandal, and history is witness of multiple scandals by multiple US based banks. Anyways, Goldman may say, why don't we do one thing? Let me buy this 30% stake. Now, let me buy this 30% stake, and I will give you $35 per share, which I agreed. And now it's my problem how I would be selling this 30%. Or probably I might be holding this 30% for a longer period of time. Probably another 5 years, another 6 years, another 10 years, something like this. Private equity firm have no problem. Private equity firm will say, I am the most happiest person. You give me $35 per stock and do what you like. This is first. Other is Goldman will create a syndication. And what the hell is syndication? Goldman will say, I alone cannot sell 30% in the market. Probably because of the valuation issue, probably because the market is not deeply discounted, and so many issues. Let me create a syndication. Let me give 2% to each bank. And let me have 15 banks. As we speak, the interbank market holds near about 6,000 banks. For a big bank like Goldman Sachs, finding 15 banks and 20% per, 2% per bank, 15 into 2%, which means 30%, is nothing. It is nothing for Goldman Sachs. This is syndication. But when it comes to syndication, there are facilities that need to be signed by Goldman Sachs with other bank. I'm not saying that all these facilities to sign at the same point of time. And Goldman will get all these facilities. So let me study for you. One is a revolving credit facility. One is the standby facility, transferable loan facility, multi-currency loan facility, bidding facilities, acceptance credit facilities, mezzanine finance facilities, evergreen facilities. But why I'm talking about facility? That's very important. Did you notice that? Because suppose the valuation of that 30% is 2 billion. It is not easy for Goldman to spare 2 billion from their pocket and give this to this private equity. Goldman will raise this 2 billion. It could be any commercial paper, it could be certificate of deposit, it could be issuance of the short, long, or mid-term bonds. They would be raising this 2 billion, estimating how much interest they would be paying and how much money they would be making, including or excluding the fees if they would holding this stock for a longer period of time. Now these facilities will matter. Let me study for you. Revolving credit facility, standby facility, transferable loan facility, multi-currency loan facility, bidding facility, acceptance facilities, mezzanine finance facilities, and evergreen facilities. That's a bloody point. But there is a condition. And what the hell is condition? That condition is the hospital owner who still holds 70% of the stake, because 30% he gave this to private equity firm. And now hospital owner will say, though Goldman bought 30% from that private equity firm, but that doesn't mean that Goldman will sell this 30% in one go, which means he would be having one important thing which is called lock in. He will say Goldman has to wait for 6 months before selling this stock, all 30% in one go, because the hospital owner feared that if Goldman would be selling the whole at one go, then it would have a serious trouble for that hospital owner. That's the main point. He would be having the lock-ins. That's very important point. And here comes the complexity. Because Goldman need to read lock-ins carefully. He need to understand the waiting period carefully. He need to understand the impact of financing cost, because this 2 billion which he paid to private equity firm for 30% stake is not from their pocket, is by an investor pocket. A Goldman needs to understand that also. Henceforth, the block trades are never been easy the way you look at it. See you in the last part, part 3. Part 3 and last of the video, titled Block Trades Are the Most Fraudulent Practice. You know, guys, Goldman in this deal bought 30% of this hospital stock from that private equity firm. He paid $2 billion upfront to the private equity firm. And that 2 billion they raised in the form of credit line from the interbank market. Now, did you ever notice that to whom Goldman would be selling this? Would Goldman be selling this to a normal investor? No. If they would be selling this to a normal investor, it would be taking years for Goldman to sell. And since they raised $2 billion, they don't have the sufficient time to wait. They need to encash it. So Goldman left with limited options. Number one, they might go to hedge funds to have a transaction. Hedge funds always buy the equities, always. They may go to the high net worth individuals, Mr. Bill Gates, Mr. Warren Buffett, all them, so that they can explore of thinking their investments, their surplus cash in this company, which is a hospital company, as per our example. They may go to the family offices. Now, what the hell is family offices? Family offices means all high net worth individuals, they invest their money via a dedicated office. And that office is known as the family office. So practically speaking, that family office is managed by professionals, but the reality is after, Archios Capital Management scandal, who was also a family office of Bill Huang, we all know that how these family offices work. Anyways, so there is a problem in this block trade. What the hell is problem? Let me give you an example from our foreign exchange market, and let me link this with this example. Suppose today Microsoft is selling 500 million GBP in US dollars. So let's take an example. Microsoft US get 500 million GBP from their customer, whatever, and they wanted to sell in dollars. What do you think? Microsoft have all top banks in their panel: Goldman, JP, Citi, Wells Fargo, Morgan Stanley, probably Deutsche, Commerce Bank, ANZ, Westpac, everyone. Would Microsoft be calling only one bank? No. The treasury function of the Microsoft would be calling everyone: Goldman, Citi, Morgan Stanley, Wells Fargo, UBS, Barclays, Bank of America, JP Morgan Chase, almost everyone. So one deal of two, say 500 million GBP would be circulated in an interbank market, and it would be multiple times. The more banks you would be adding, it would be multiple times. Now, what is the problem? Similar situation we have in investment banking. When the Goldman would be selling this, suppose in tranches, because selling 40% at one go is fairly impossible. That way, Goldman would be contacting all investor once, not together, once. And there is a huge hype in the market that a block trade is going to get happen. This may trigger a substantial sell-off in the system even before a block trade is going to get occur. Of course, theoretically speaking, Goldman would be signing the non-disclosure agreement with the client that we are here for discussion and you won't be selling or sharing this information with the public. But we all understand the value of non-disclosure agreement, be it any country of the world. Henceforth, there are multiple chances that the employees of the big banks, those who engaged in, I would say, those who engaged in these block trades, they might be tipping off deliberately or non deliberately to their counterparts, to the banks, to the family offices, to the pension fund, to the credit risk fund, that this potential block trade to happen. One thing which I haven't covered is the type of underwriting. Whether this is soft underwriting or whether this is hard underwriting. This is something I haven't covered. I might be covering later on. Because if you are thinking that block trades do not have an underlying, then you are completely incorrect. They have underwriting. Now, this situation becomes more difficult in case of startups having losses. In India, we have seen in case of Paytm, in case of Zomato, in case of Nikia, in case of Policy Bazaar, in case of Card Trade, when their IPO launched, the big private equity and the venture capitalist firm decided to do offer for sale. But what the hell was offer for sale? I repeat, the statistical definition of offer for sale is that an existing investor is quitting, but that existing investor holding a substantial share. He is not going to an exchange selling 1 share, 2 share, 3 share, 4 share, 5 share. Did we ever got to know when the existing investor sold, who bought it? We never get that information because this is the beauty of the block trade. In block trade, the face value matters. And that's a very important point in block trade. Face value matters. Having said that, in block trade, one important thing that really matters is the timing and the lock-in of offer for sale. You will also never get to know that the firms who arranged initial public offering for loss-making startups, be it India or be it any country of the globe, how they are engaging the block trade. You will never get to know. All of a sudden, you will see, oh my God, this company was at 650 few minutes ago. What the hell? Now it is 580. From 650 to 580, what the hell? This is called block trade. And if you are thinking that the people do not have an information about the block trade, then you are incorrect. Now, practically speaking, block trade is of two types. Probably in the next videos, we might be covering this. Number one is the block trade without having any credit line. And that credit line is by the Goldman. Is for Goldman by the Interbank. I repeat, for Goldman by Interbank. Other is block trade without any credit line, which, by the way, is very risky. And it may end up huge triggers for that investment bank and probably that company himself who is entering into the world of block trading. Block trading is a very interesting word. Very interesting word. And if we gather information, we will get a lot of knowledge. But unfortunately, be it India, be it any country of the globe, you rarely get an information of the block trade. You will never get that block trade can even be syndicated, which means that a 10% stake selling in one company might be offered to multiple companies 2%, 2%, 2%, 2%. This is Rahul Magan from Treasury Consulting Group. You know my personal number 9899242978. In case you have any questions, you can WhatsApp. If you feel that the question is genuine and deserves an answer, we will surely reply. Have a great time ahead. Welcome to the world of block trades.